Imagine building one of the world's largest infrastructure investment empires, owning airports, power stations, ports, roads, wind farms, telecommunications networks, and billions of dollars of assets across more than 20 countries. On paper, Babcock Brown appeared unstoppable. Its market value exceeded 9 billion Australian dollars. It managed and owned infrastructure worth more than $100 billion. Investors believed they weren't buying another investment bank. They were buying ownership of the world's essential infrastructure. Every airport collected passengers. Every toll road collected vehicles. Every power station generated electricity. Every asset appeared to produce reliable, predictable, long-term cash flow. It sounded almost risk-free. But hidden beneath this enormous empire was a financial model built upon one assumption: debt would always remain available. Unlike companies that build products, Babcock Brown built financial structures. It specialized in finding infrastructure assets, borrowing enormous amounts of money to acquire them, placing those assets into listed investment funds, earning management fees, collecting performance fees, and then using its growing balance sheet to repeat the process again. The more assets it acquired, the more fees it earned. The more fees it earned, the more investors trusted the company. The more investors trusted the company, the easier it became to borrow even more money. Growth itself became the engine. But that engine had one critical dependency: continuous access to cheap credit. As long as banks kept lending, the model appeared brilliant. Every successful acquisition increased earnings. Every increase in earnings supported a higher share price. Every higher share price improved borrowing capacity. The entire business became a self-reinforcing cycle. For years, almost nobody questioned it, because the assets were real, the cash flow was real, the profits looked real. What investors failed to notice was that almost every dollar of growth depended on borrowing another dollar first. When credit flowed, the empire expanded. When credit stopped, everything would begin moving in reverse. And in 2008, the world's financial system would suddenly stop lending. To understand why Babcock Brown collapsed, you first need to understand what it actually sold. It wasn't electricity. It wasn't airport tickets. It wasn't toll roads. It sold investment structures. Imagine an airport worth $1 billion. A traditional company might buy the airport, operate it, collect passenger fees, and slowly repay the loan over decades. Babcock Brown approached the same asset very differently. First, it borrowed heavily to acquire the airport. Then, instead of keeping the airport entirely on its own balance sheet, it packaged the asset into a listed infrastructure fund. Investors purchased units in that fund. The fund now owned the airport, but Babcock Brown remained the manager. That distinction is extremely important. The company no longer needed to own every asset to keep making money from it. Instead, it earned recurring management fees, advisory fees, performance fees, acquisition fees, and financing fees. One successful acquisition could generate income several different ways. Then the process started again. Acquire another asset, create another fund, raise more investor money, arrange more debt, earn more fees, repeat. It looked like an almost perfect business because every successful transaction produced immediate income, while the long-term debt largely remained inside the individual investment funds. To investors, the company appeared remarkably asset-light, but financially, everything remained connected. because every new acquisition still required banks willing to provide enormous loans. Without debt, new acquisitions stopped. Without acquisitions, new funds stopped. Without new funds, management fees slowed. Without growing fees, profits stopped expanding. The entire machine depended on one thing: banks continuously saying yes. That dependence remained almost invisible because during the early 2000s, credit was everywhere. Banks competed aggressively to lend. Interest rates remained relatively low. Infrastructure became one of the world's most popular investment themes. Money flowed almost effortlessly. Babcock Brown wasn't simply benefiting from the credit boom. Its entire business model was built upon it. For years, the model looked almost flawless. Every acquisition appeared to prove management was right. The more infrastructure Babcock Brown controlled, the more valuable the company seemed. But hidden inside every transaction was a financial assumption almost nobody questioned: that debt could always be refinanced. This is where many investors misunderstood the business. They believed debt was simply used once to buy an airport or a toll road. In reality, the company constantly refinanced existing borrowings while simultaneously arranging new loans for new acquisitions. Imagine buying a house with a short-term loan, expecting that when the loan expires, the bank will simply issue another one. If that continues, everything works. But if the bank suddenly refuses, you don't lose the house because it stopped producing value. You lose it because the financing disappears. Babcock Brown operated on exactly the same principle. Many of its borrowings matured long before the underlying infrastructure assets generated enough cash to repay them. That wasn't considered a problem. Management expected banks to refinance the debt, just as they had done for years. This strategy worked brilliantly during expanding credit markets. Suppose an airport produced $70 million of annual cash flow. The airport itself might be worth $1 billion, but only a small portion of that purchase price came from equity. Most came from borrowed money. As long as banks renewed the loans, the airport continued generating stable cash flow, investors remained confident, and everyone earned returns. But notice something important. The airport's value didn't determine whether the financing continued. The banks did. If lenders decided the risk had increased, they could demand more equity, higher interest rates, additional security, or refuse refinancing altogether. That single decision could instantly change an investment that appeared perfectly healthy into a liquidity crisis. The infrastructure hadn't failed, passenger numbers hadn't collapsed, electricity demand hadn't disappeared, the cash flows were still largely there, but the financial engine supporting those assets had become dependent upon confidence rather than infrastructure itself. By early 2007, very few people believed that confidence could ever disappear. Within months, it would.
Then came 2008. The global financial crisis didn't begin by destroying infrastructure. It destroyed confidence. Banks around the world suddenly stopped trusting each other. After the collapse of Bear Stearns, followed by Lehman Brothers, global credit markets froze. This is the moment many people misunderstand. Babcock Brown's airports, ports, power stations, and toll roads didn't suddenly stop producing cash. Passengers still flew. Cars still paid tolls. Electricity was still consumed. The assets continued working. The financing system didn't. Banks that had spent years competing to lend billions of dollars were now trying to reduce lending as quickly as possible. Instead of asking, "How much can we lend?" they began asking, "How much can we recover?" That single change completely reversed Babcock Brown's business model. Loans approaching maturity were no longer automatically refinanced. Banks demanded immediate debt reduction, higher equity contributions, additional collateral, or refused refinancing altogether. Imagine owning a shopping center worth $1 billion Australian dollars funded with $800 million of debt. Nothing about the shopping center changes. Rent is still collected. Tenants are still operating. But when the loan matures, the bank says, "We're only prepared to lend $600 million. Where does the remaining $200 million come from? You must either inject new equity, sell assets, or default." Now imagine facing that problem not once, but across dozens of billion-dollar infrastructure investments at the same time. That was exactly Babcock and Brown's position. Management suddenly wasn't trying to grow anymore. It was desperately trying to survive. Every refinancing negotiation became a race against time. Assets that looked enormously valuable 1 month earlier became difficult to sell, not because buyers disappeared, because buyers also depended on bank financing. Without available credit, there were fewer bidders, lower valuations, and slower transactions. The company's escape route, selling assets to repay debt, was collapsing at exactly the same speed as the credit markets themselves. By late 2008, Babcock and Brown was no longer fighting a market downturn. It was fighting mathematics. The company's problem was no longer whether its infrastructure produced cash. It was whether enough cash could be produced fast enough to satisfy lenders. This distinction is critical. Infrastructure is designed to generate stable returns over decades. Debt can become payable within months. Those two timelines suddenly collided. Management launched an aggressive survival plan. Assets were put up for sale. Operating costs were reduced. Projects were delayed. Negotiations with banks continued almost daily, but every solution created another problem. Consider one airport worth $1 billion before the financial crisis. Potential buyers might previously have borrowed 80% of the purchase price. Now, banks were only prepared to finance perhaps 50%. Immediately, the number of qualified buyers collapsed. Fewer buyers meant lower offers. Lower offers meant selling assets no longer generated enough money to repay existing debt. Suppose the airport had $800 million of outstanding loans. Before the crisis, it might sell for $1 billion, leaving equity after repayment. After the crisis, if the highest offer fell to $750 million, selling the airport wouldn't even fully repay the debt. The company would still owe money after selling the asset. This became known as a debt overhang. Ironically, the more Babcock and Brown tried to sell, the more the market realized it urgently needed cash. That weakened its negotiating position even further. Banks knew the company was under pressure. Banks knew the company was under pressure. Credit rating agencies knew the company was under pressure. Everyone negotiated from a position of strength, except Babcock and Brown. Meanwhile, its share price collapsed. As equity value disappeared, another problem emerged. Banks had originally lent money because the company appeared financially strong. Now, the falling share price signaled increasing risk. Some lenders demanded even more security. Others refused further exposure entirely. The company entered a vicious cycle. Falling confidence reduced financing. Reduced financing forced asset sales. Asset sales produced disappointing prices. Lower asset values destroyed even more confidence. By early 2009, the infrastructure empire wasn't collapsing because the assets had failed. It was collapsing because the financial structure holding those assets together had completely broken apart. By early 2009, Babcock and Brown had reached the point where refinancing alone could no longer save the company. The debt burden had become too large, asset sales were too slow, and credit markets remained largely frozen. On 13 March 2009, the board made the decision it had spent months trying to avoid. Babcock and Brown entered voluntary administration. This wasn't immediately the end of the infrastructure. It was the beginning of dismantling the financial empire. Administrators took control of the company. Their job was no longer growing the business. It was recovering as much value as possible for creditors. Notice the order of priority. Banks and secured lenders were paid first, then other creditors. Shareholders came last. That distinction proved devastating. By the time the company's debts were assessed, there simply wasn't enough value left for ordinary shareholders. Investors who once owned shares in one of Australia's largest infrastructure companies were effectively wiped out. The collapse erased billions of dollars in market value. But something remarkable happened next. The airports didn't close. The toll roads didn't stop collecting traffic. Power stations continued generating electricity. Ports continued handling cargo. Because those assets still produced real economic value. They were gradually sold or transferred to new owners. Infrastructure funds were restructured. Individual assets found buyers over time. Banks recovered part of their loans through those sales, but the holding company, Babcock and Brown Limited, never recovered. The business model that connected hundreds of infrastructure investments through enormous leverage had completely failed. Administration eventually became liquidation. The listed company disappeared from the Australian Securities Exchange. Its name, once associated with one of Australia's greatest financial success stories, vanished from public markets. Ironically, many of the infrastructure assets continued producing reliable cash flow for years afterwards. The assets had never been the problem. The financing structure built around them was. In the end, Babcock and Brown didn't run out of valuable assets. It ran out of time to refinance the debt that controlled them. And when the debt structure collapsed, the company disappeared, even though much of the infrastructure continued operating successfully under entirely new owners. Babcock and Brown didn't collapse because infrastructure stopped working. It collapsed because leverage stopped working. That distinction permanently changed how investors viewed infrastructure finance. For years, the company had been praised as an innovator. Its ability to combine infrastructure, investment funds, debt markets, and institutional investors looked revolutionary. In reality, the model worked only while global credit expanded. Once credit contracted, every advantage became a weakness. Debt that accelerated growth accelerated collapse. Leverage that magnified returns magnified losses. Financial engineering that once increased shareholder value became impossible to sustain. The irony was extraordinary. Many of the assets Babcock and Brown acquired remain valuable today. Airports still transport millions of passengers. Power stations still generate electricity. Ports still support international trade. Wind farms still produce renewable energy. The infrastructure never failed. The financing model around it did. Today, the collapse is studied in business schools around the world, not because the company bought poor assets, but because it confused access to debt with permanent capital. The business assumed refinancing would always be available. The market proved otherwise. Babcock and Brown also exposed another important lesson. Cash flow and liquidity are not the same thing. An asset can generate reliable income for decades, yet still become impossible to finance during a credit crisis.
Many investors believed infrastructure itself guaranteed safety. What actually mattered was how that infrastructure was financed. In the end, Babcock and Brown wasn't destroyed by airports, toll roads, or power stations. It was destroyed by believing that financial markets would always remain open. When the credit markets closed, the company's growth engine became a debt trap. Its infrastructure empire survived under new owners. Its financial empire did not. Babcock and Brown became one of the clearest reminders that the strongest assets in the world cannot protect a business built on financing that can disappear overnight.